are privileged to have a special guest join us on the program now, Becky Swansburg, CEO of Stonewood Financial. Now, Becky, you are a Washington insider. I'll dub you. Spend a lot of time on Capitol Hill and still pay pretty close attention to what goes on up there. We are in tax season. We are in election season. So there's no lack of news or paying attention to what is going on up there and what it means for us personally. What are you paying attention to right now, maybe in the news or outside of the news that people need to know might affect their financial future?
Yeah, well, unless you've been living under a rock, and actually it would have to be a rock that can't even get a direct mail, you are clearly aware that there is an election. It is what everyone is talking about, every newspaper, every news program. We are marching towards not just congressional elections, but a presidential election this year. And in any election year, we kind of have to evaluate two different ways that it could potentially impact savers and, of course, their retirement assets. We have to look at kind of the near-term impacts. Who wins? Who will be in the White House over the next 4 years? What does Congress look like? But then we also have to evaluate what's the long-term impact of this election outcome? What is kind of the sum of all the spending legislation, of all the initiatives of Congress and this White House? And what is that going to mean for our national debt, for our spending, for our tax environment, really for decades to come?
And I have seen you speak on multiple occasions. You always bring up what is, quite frankly, sometimes some scary numbers and statistics. You pay attention to kind of the Congressional Budget Office and their reports and things like that. So the last time I saw you and we spoke, you mentioned that of course we are worried about the imminent election to come, but that the forecast and outlook for the next 20 to 30 years really means that it is time for savers and investors to start thinking proactively about their money and their taxes.
Yeah, Peter, you are absolutely right. You know, if you were just going to retire for the next 2 years or the next 4 years, I would say what matters most is this election cycle. But most of us want to be retired 10, 20, 30, 40, even 50 years into the future. And so I believe that the biggest impact that Washington is going to have on retirement savings over the next decades to come is really around this spending, what it's doing to our national debt, and what it means for taxes. So every year, I'm a government geek. I like to read the Congressional Budget Office puts out full data on every dollar that the U.S. government took in, and then every dollar that the U.S. government sends out and expenditures. And the numbers are really interesting. So the most recent data we have is actually for fiscal year 2022. The 2023 numbers should be coming out momentarily, but let me tell you, it's not gotten any better. In that year, the government took in about $4.9 trillion of revenue, primarily over 50% of that was individual income taxes. Now, is $4.9 trillion a lot of money? It depends on how much you spend. I can only tell you how much that is depending on how much is going out. And that's where I think the story gets really important for savers. We brought in $4.9 trillion, but then on mandatory spending alone, mandatory spending is spending that Congress does not control. It's things like Social Security, Medicare, kind of all the responsibilities our government has to citizens that are already codified in law. Mandatory spending alone, we spent $4.1 trillion. If you add on service to our debt, because obviously Congress also doesn't control that, we have to have debt service, it was about $4.6 trillion of spending. So we took in $4.9 trillion and 4.6 of it was out the door before Congress even met. Like if Congress had not spent a single dollar, we can barely balance our budget as a nation. Now, of course, Congress did meet and they did spend. They spent about $1.7 trillion additional dollars on everything from, funding defense and the Department of Education to any of these specialty funding bills that we've seen in recent years. And so we end up with this $1.4 trillion gap between what we bring in and what we send out. The challenge isn't necessarily the gap. The challenge is that we really don't have any levers to pull as a nation to control the spending. So we have an aging population that's going to be requiring more Medicare, more Social Security. We have a debt that is growing at interest rates that are still elevated. And Congress hasn't, Republicans or Democrats, really shown any interest in dramatically reducing the amount that we spend through the appropriations process. All this debate to avoid a government shutdown has just been debate over how much the budget grows, not really shrinking the budget. We're trying to stop too much growth. So because we can't really control spending on that side of the ledger, the only place for our government to look is, of course, raising more revenue on the other side. And that's why I think all savers, but particularly savers who are upper middle class and above, really have to focus in and realize that we may be entering into a long-term rising tax environment.
Those discussions about the government shutdown, and as we are recording this, another debate about that looming into the future. Yeah, but even when the parties finally agree, a minute past the deadline at 12:01 a.m., and the government somehow goes on the next day, it's not like it ever solves anything, Becky. It's like this debate is just kicked down the road 3 or 4 additional months, and then we are facing this again. When does this come to a head? I mean, can we continue to operate under that kind of pretense?
No, and it's going to have to come to a head, because the thing that is driving our problems in America is not really congressional spending or what's happening in the White House. It's really the demographic realities of our nation. We just have benefits that are due to a rapidly aging population. It was interesting. The Census Bureau said that between the 2010 census and the 2020 census, we had the most rapid growth in Americans age 65 plus of any period since the 1890s. So over 100 years since we've seen this many old people in America that require the things that we want for them. So I think that's really baked in. Now, the challenge for savers is, if we are going to start seeing this rising tax environment to offset all of this spending that the government needs, where are the vast majority of every U.S. savings dollar? They're in 401ks and IRAs. They're all these tax-deferred vehicles. And in these tax-deferred vehicles, we've all made a bet, well, my taxes in the future will be lower than they are today. That's why I'm deferring them. I'm not going to pay my taxes while I'm working. I'm going to pay them in retirement when they should be lower. That equation could get dramatically disrupted if the government now has to raise taxes to offset spending. And suddenly, all these deferred taxes have now created this huge retirement tax bill that savers weren't prepared for.
And savers, you and I and everybody listening personally, we rely on a savings, a nest egg for retirement. That's not how the government operates. They are basically shoestringing together cash flowing things as we go, and they're not very good at that, hence the $34 trillion debt. But Becky, in order to continue operating the cash flow reality into years in the future, those personal nest eggs that you and I and everybody listening have saved up have to be a target for additional tax revenue. And that's why you really encourage people to kind of run the numbers on managing and controlling the total tax liability, not just last year's tax liability.
Yeah, if you ask me what is the single most important topic for savers to focus on in 2024, it has to be diversification within the tax status of your retirement assets. And it's funny, because we diversify almost every other part of retirement. Like, the vast majority of us don't have 100% of our retirement savings in like Apple stock, right? We have already diversified our market exposure and fixed income. We're very used to diversification as a way to mitigate risk. But when it comes to tax risk, and particularly this risk of rising taxes, so many savers, I find, still have all or the vast majority of their retirement assets in tax-deferred vehicles, which means that they have no protection if taxes rise. So I think the most important thing for savers to consider this year is, what might my retirement tax bill look like with my current approach? And do I want some of those assets to instead be held in maybe tax-free accounts, so that if taxes go up in the future, I have some of my assets that are just protected from that?
Now, in order to diversify, in order to move assets from that tax-deferred bucket, the 401k, the IRA, the employer-sponsored plan, all of those matching dollars, to a bucket that is tax-free, of course, there is a cost to that. We've got to pay the taxes on those dollars, Becky. But now may be a good time to do that because at least we know what the cost would be today. We don't know what that cost might be in the future.
Yeah. It's hard to believe, and I certainly don't feel this on April 15th, but we are actually in an artificially low tax bracket rate environment today, in part because of the federal tax reform, sometimes called the Trump tax cuts, that took place. So today's tax bracket rates for middle Americans are about 30% lower than they were, let's say, in the early 2000s and the 1990s. So we could really see tax bracket rates go up by 30%, and it wouldn't even put us in a high rate environment. It would just get us back to more historical norms. So because we are in this artificially low tax bracket rate environment, if you are ever, as a saver, trying to make a decision about converting some of your tax deferred funds into tax-free accounts, you can actually do so now at a discount. But the window for that is really just this year and next year, because in 2025, the Trump tax cuts expire, which means in 2026, all of our bracket rates are going back to their older, higher rates. So that is one of the reasons why I think 2024 is the year of tax diversification. It is the year to go ahead and at least evaluate, are you happy with the tax status of your assets, or do you need some protection? Because if you need to convert, you can do so today at a discount, but that window is shrinking.
Yeah, Becky, I see a lot of retirees once they start accessing those 401ks and the IRAs and tax deferred dollars, sometimes surprised by the tax bill, kicking themselves a little bit, cussing the IRS. But the reality is, as you mentioned, tax rates right now historically low. So the pretense under which they had saved that taxes would be lower in the future has in fact occurred. That was a good deal and a good arrangement to defer and delay paying taxes. It's just now is the time to really examine managing those taxes and shifting the paradigm that from here moving forward, taxes might be, and I say that tongue in cheek, will likely be higher in the future.
Yes. So, it's interesting. Converting funds does not create a tax bill. The tax bill exists in a 401k or IRA. I know that, I've got Roth money, I've got IRA money, I've got all sorts of retirement assets. I know that they have a tax bill within them. We just have to evaluate, does it make more sense to kind of buy out the IRS today at a known rate, or kind of gamble to the future and see where rates are? And there's probably not one answer. The right answer, at least for me, was, okay, I just need to diversify. I need to make sure I have some assets that I know are protected from future tax increases. And then the rest of my funds will see kind of what the future holds. I have trouble seeing, though, a future that does not include rising tax rates. And it's important for listeners to understand it's not just income tax bracket rates. That is one component. But the other component is kind of the structure of taxation. That's around what is taxed, when it's taxed, how it's taxed, and who it's taxed for. So a good example of that could be Social Security. Right now, today, your Social Security benefit is taxable up to 85% of that benefit, but it wasn't always that way. Social Security wasn't taxable until Congress passed a law in the 80s under Reagan to make it taxable up to 50%. And then another law under Clinton in the 90s to make it taxable up to 85%. So tomorrow, Congress could pass a new law making your whole Social Security benefit taxable. Your bracket doesn't change, but suddenly you have more taxable income. Of course, less money to actually spend on retirement because more is going to the IRS in Washington.
Well, two things in life can be said to be certain, right? Death and taxes. I won't ask you to predict the outcome of the election, but let's be realistic here and predict the outcome of the tax environment into the future. Taxes are probably not going away and likely getting higher.
Yeah. I would say the biggest thing that I think hinges on the outcome of the election is kind of the attitude towards 401ks and IRAs that we've seen the past 4 years in Washington. If you remember, through the Build Back Better legislation, through President Biden's 2024 budget proposal, there's kind of been this running theme that tax-deferred savings, IRAs and 401ks are really more for middle-class Americans, and that wealthier Americans are abusing them. Once you get too much, the government will say too much money in those accounts, suddenly you shouldn't get tax benefits for them anymore. I think there's a lot of heat and pressure on 401ks and IRAs. If we have a Democrat in the White House and maybe Democrats in control of the House or Senate, I think we will see more legislation looking for ways to bring additional tax revenue out of 401ks and IRAs. I think we have less of that pressure if we have a Republican in the White House and Republicans in control of the House or Senate. But on long-term taxes, it doesn't matter who's in the White House. One thing that a lot of people might not realize is the thing that drives tax risk, this risk of unknown taxes in the future, is not really Republicans. It's not really Democrats. It's the fact that in America, we have a 2-year election cycle. And it's incredible to realize, like here in America, every 2 years, we have new government. It means I don't care how good the government is now. I don't care what great things they put in place. In 2 years, all of that can come undone. And, I mentioned at the beginning that retirement isn't about 2 or 4 years. We're about the next 15 to 20 election cycles in this nation. And that's just too long to try to predict what is going to happen. 20 years ago, we couldn't have predicted where we are today. 20 years from now, who knows? The most important thing is just that some of your retirement assets are kind of protected from all that volatility that we'll see coming from Washington.
She is Becky Swansburg, CEO of Stonewood Financial, Washington insider, paying attention to what happens on Capitol Hill, translating it to what happens in your wallet, discussing the tax liability of retirement funds for the American saver and investor, and encouraging you to be proactive with your tax management. Becky, a great time on the program, and I look forward to having you back here in the near future.
Can't wait to read the tea leaves on the next part of the election.
Thank you very much, Becky. Hey everyone, Peter Richon here. Hope you enjoy the content. As always, make sure that you like, subscribe, share the videos with others that may find this information helpful. And as always, you're welcome to be in touch or to submit questions or comments. You can comment below the video anything that you'd like to see or hear shared on our YouTube channel and in future videos. If you got a topic that you've been thinking about or is of concern for you financially, be sure to let us know. We'd love to help you by discussing it on the channel. So appreciate the continued views and the likes and the subscribes, the shares, the comments, always helpful. We look forward to getting you the information that you need.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.